Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, global markets reporter at Nasdaq. In honor of March Madness, we have Ryan Detrick, chief market strategist at LPL Financial, to discuss final four factors for the stock market in 2021: vaccines, policy, profits, and rates. Ryan, it's great to see you as always. Welcome back to Trade Talks.
Thank you, Jill. Looking forward. Let's not talk about our brackets. Mine's kind of all busted up, as they say. Let's just stick with economy and stocks here.
I was just going to say, you know what, we all have to look at the markets because everybody's bracket has been blown up, starting with Ohio last Friday. Yes. So we'll stick with what we know, and we'll talk about the markets. And
that's right.
While you see several strong competitors in this field, there's only one winner that will push stocks higher over the balance of the year. Before we get into your winning pick, let's get an overview on the four contenders, starting with vaccines.
Yeah, you think about it, they're one of the biggest keys to the reopening, right? I mean, 25% of everyone in the United States has got at least one vaccine. I'm actually getting mine tomorrow. I think my wife is getting hers literally as we speak. A lot of older people obviously have had both, and that's just such a big part. We've talked a lot about the reopening trade and getting back out there and getting people in restaurants and we're going to go to Disney in a couple months, right? Things like that, getting back out there, the vaccines are so important. The caveat, of course, is, look at what J&J is saying, having trouble getting as many vaccines out as maybe they thought they were going to. Also, the variants are out there. So it's anything but smooth, but, we're going the right direction to finally beating COVID.
And moving along to policy and the impact to inflation, that really has been a key factor.
No doubt about it. One of the biggest questions we receive at LPL Research from our more than 17,000 advisors is record monetary stimulus, record, fiscal stimulus. There has to be inflation, right? Now, let's just take a look at the Fed very quickly. The Fed has said, hey, rates are staying low for a long time. We're still a backstop. We think that's a positive. All the fiscal stimulus that we've seen, 1.9 trillion just a couple weeks ago, and now we're already looking at 3 trillion, right, for the next infrastructure plan. So again, those are more positives, though. They're trying to help the people that have been impacted by this, to help open up the economy and help us get a bridge to the other side. Real quickly, we do not think we're going to have massive inflation down the road. We're not going to turn into Zimbabwe. Some of the major structural things like the Amazon effect, productivity, technology, those things have been in play for a long time. Putting a cap on inflation, maybe a little more inflation can happen later this year, but we don't think we're going to have massive inflation due to all the stimulus.
And Ryan, you and I have spoken about justifying valuation for a number of months now. What are your thoughts on profit supporting those valuations?
Yeah, there's no question about it. One of our, actually, you say, biggest concerns or what keeps us up at night. Valuations are high. There's no doubt about it. But then you look, we're looking at maybe 25% earnings growth in the United States. It feels like every earnings season, earnings come in way better than expected, and it's a little bit higher. Emerging markets, Joe, looking at maybe 35% earnings growth. Developed international, 30% earnings growth year over year. That's in 2021. And the truth is, these earnings growths are justifying a lot of this move. Could we be a little ahead of ourselves? Let's be honest. A 75% rally in 1 year. Hey, maybe stocks are a little ahead of themselves, but the earnings look like it's going to help justify where we are, and probably a continuation of this bull market.
And finally, rates have been a key factor in the first quarter. That's where we're getting that chop from, right? So it seems to be the bond markets are telegraphing something very different about inflation versus what we're getting out of policy.
Yeah, our take on the 10-year yield, right? 10-year yield was at 50 basis points last August, recently up above 170. It's the bond market's way of saying there could be a little bit of inflation coming, but also likely a stronger economy. Jill, we went back to World War II. We found 13 periods of a higher trending 10-year yield, at least 100 basis points. The S&P was higher 10 of them. The S&P's been higher during every period of a 10-year yield, higher 10-year yield every time since the mid-90s. I think it's like 3 or 4 times. So the truth of the matter is this: a higher trending yield is probably the bond market's way of saying, listen, the economy's getting better, and the stock market usually likes that. So we're not scared, I guess you could say, of a 170 10-year yield. We think maybe go a little bit higher, and it's justified in our view.
And Ryan, of the four, who, or what should I say, does the LPL Financial team think will take the top spot?
Yeah, they're obviously all important on their own right, but at the end of the day, it's the vaccines. We think, we need the vaccines to get out there to help people get back out there, spend some money, get back to their jobs, get this economic cycle of growth, which technically we're still in a recession, although most people don't agree there. We're easily less than 1 year, obviously, of a new expansion. Keep this new expansion going, and the vaccines are the most important part, and we're still comfortable with how that looks, and more vaccines are on the way, and hopefully the second half of this year will be a really good economic expansion for the U.S.
All right, Ryan, appreciate the insight as always. Thanks for joining us on Trade Talks, and thanks for joining me. I'm Jill Malandrino, global markets reporter at Nasdaq.